It wasn't a trade dispute, it wasn't a tactical rebalancing, it wasn't even a simple act of geopolitical spite. It was the mathematical inevitability of a creditor recognizing an insolvent debtor. The pattern is unmistakable. When the world's largest factory stops buying the debt of the world's largest consumer, something breaks. We have seen this before in Madrid, in London, in Berlin. The mechanic is always the same. Empire overextends, debt becomes unpayable, creditors quietly exit, then the currency collapses. China dumping $53 billion in U.S. Treasuries isn't a headline, it is a siren. It echoes the exact liquidity crisis that broke the British pound in 1931. Most observers agree the sell-off is accelerating. The incentive is clear. Why hold an asset that is guaranteed to depreciate in real terms? Under these constraints, the rational move is to sell first, before the crowd panic begins. This is not about politics, it is about survival. We are witnessing the early stages of a sovereign debt liquidation event. The scale is unprecedented, but the mechanics are ancient. To understand where this leads, we must look back not just a few years, but centuries to the moments when other empires faced the exact same wall of arithmetic. Three specific historical precedents reveal the roadmap: first the Spanish Empire, then the British Empire, and finally the Weimar Republic. Each followed a precise sequence: peak dominance, unsustainable costs, a monetary shortcut, and finally a flight into hard assets, leaving the middle class holding the bag. Consider the Spanish Empire. In the 16th and 17th centuries, the Habsburg monarchy controlled the first global superpower. Galleons flowed from the Americas, laden with silver and gold. It seemed like infinite wealth. But the costs of maintaining a global hegemony were staggering: constant wars in Flanders, a sprawling bureaucracy. The crown spent the silver before it even arrived in Seville. They borrowed against future fleets. When the costs exceeded the plunder, they chose the monetary shortcut. They debased the currency. They flooded the economy with copper coins known as vellon. The result was the price revolution. Inflation tore through the social fabric. A soldier in the Spanish Netherlands might wait months for pay that when it arrived bought half the bread it used to. Creditors, specifically the Genoese bankers, saw the arithmetic. They demanded hard assets or stopped lending entirely. The Spanish crown defaulted on its debt multiple times in 1557, 1575, and 1647. The empire didn't vanish overnight, but its financial heart stopped beating. The middle class was hollowed out. Land ownership concentrated in the hands of the grandees, and the empire began a long, painful slide into irrelevance. Just like the Spanish Empire, the British Empire found itself trapped by the same merciless arithmetic 3 centuries later. This is the most critical parallel to our modern situation. By the early 20th century, London was the financial capital of the world. The pound sterling was the reserve currency, considered as good as gold. But the First World War shattered Britain's balance sheet. To fight the war, Britain liquidated its foreign investments and borrowed heavily from the United States. By the 1920s, the debt burden was crushing. The government attempted to restore confidence by returning to the gold standard in 1925 at pre-war parity. It was a political decision that ignored economic reality. The pound was overvalued, and British industry became uncompetitive. Here is the key: other nations held massive reserves of sterling, just as the world holds US dollars today. But smart observers saw the insolvency. France, in particular, began aggressively selling its sterling reserves for gold. In the late 1920s, they were the China of that era, a major creditor recognizing that the debtor could not pay in real terms. The pressure mounted until September 1931. A run on the pound began. The Bank of England hemorrhaged gold on September 21st. Britain was forced to suspend the gold standard. The pound crashed. In a single stroke, the savings of the global middle class held in sterling were devalued. A clerk in London who had saved for decades saw his purchasing power evaporate, while those who held gold or foreign assets preserved their wealth. It marked the end of the British century and the beginning of the American transition. Just like the British Empire, the Weimar Republic attempted to paper over a structural deficit with printed liquidity, but with far more catastrophic results. The German example from 1914 to 1923 serves as the extreme case study of debt liquidation. Burdened by war debts and the crushing reparations of the Treaty of Versailles, the Weimar government faced a choice: austerity and default, or printing money to meet nominal obligations. The political incentive was to print. The payoff was keeping the government functioning for one more day. The risk was the total destruction of the currency. They chose to print. At first, the inflation was manageable, almost pleasant for exporters, but soon the velocity of money accelerated. Foreign creditors and domestic savers realized the mark was doomed. They fled into anything tangible: pianos, machinery, real estate, and foreign currencies. By 1923, the currency had lost its utility completely. A student ordering a cup of coffee might find the price had doubled by the time he finished drinking it. The middle class, which held its wealth in cash, savings, and bonds, was wiped out entirely. The only winners were those who had borrowed heavily to buy hard assets. As their debts were inflated away to nothing, the social contract was destroyed, paving the way for extremism. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is backed by hard assets. Stage 2 is expansion. The economy grows and takes on debt. Stage 3 is overextension. Costs exceed revenue, deficits become structural. Stage 4 is debasement, diluting currency to pay bills. Stage 5 is liquidation, the pivot point. Creditors dump the debt for gold. Stage 6 is crisis, panic selling. Stage 7 is reset, wealth transfer, just like the liquidation phase in 1931. Current data suggest we are entering Stage 5. The $53 billion sell-off by China is not isolated. Central banks are voting with their balance sheets. The only variable is timing and pain. Focus your education on economic history. Resilience comes from understanding the data, not fearing it.